Hey everyone, and welcome back to the Rich Habits Podcast question and answer edition brought to you by Public.com. These Thursday episodes are all about answering your questions in real time. We find a bunch of questions that you guys ask us via Instagram DMs at Rich Habits Podcast or via email at richhabitspodcast@gmail.com. We pull them all together, we pick the most random ones we can, and we try and answer them here on the show every single Thursday, and we have so much fun doing it.
I love these episodes. I say it every week because I feel like it really expands our minds into, we always say personal finance is personal. And when we answer these questions, we're really digging deep on all of these crazy different topics around finance and business and mindset. So these episodes are just a blast to make.
They are. And again, these are kind of like off the dome. We don't really pull too much together here. We review a couple of them if we have any like lingering questions. But this is Robert and I's raw thoughts. But Robert, before we jump into the episode, it's really important that everyone understands the reality that if you ever want to retire, right, stop trading time for money, you need to have a nest egg that's growing for you over time.
And the easiest way anyone can begin investing towards their future is on public.com. They make it incredibly simple to build a multi-asset portfolio, including ETFs, stocks, bonds, crypto options, and more. They also offer access to industry-leading yields of up to 3.8% APY for your emergency fund.
And for a limited time, you can earn a 1% match on all IRA deposits, IRA transfers, and 401k rollovers. That's $1,000 of free money for every 100,000 you roll over into their platform. So if you have an old 401k that you haven't really looked at in a while, or it's on a stinky broker you don't like using, roll it into Public, get your free 1% match.
Fund your account in 5 minutes or less by heading to public.com/rich habits to claim your 1% match today. Paid for by Public Investing, and full disclosures in the podcast description.
So our first question comes from Mandy. Mandy says, "Hi all, this is Mandy. I love your show and I like to get some clarification on a question. A couple episodes ago, you mentioned direct indexing and that everyone that owns VOO should direct index into the S&P 500 instead. So I was wondering, do we go and sell our VOO or maybe even our QQQ in our portfolios and start direct indexing it? I've got about $100,000 in VOO, QQQ, VGT, things like that. So should I put all $100,000 into direct indexing? Do I do half and half and keep some ETFs? What do you guys think?" So Robert, great question, right? We had Steven Sykes from Public.com, he's their chief operating officer, on the show recently to talk about their new direct indexing product. And it's awesome. So essentially with as little as $1,000, you can begin to direct index some of your favorite indices. They've got over 100 indices over there. Go check them out. Now, what is cool about direct indexing is, again, instead of owning an ETF, right, like VOO, who then goes and owns the S&P 500, which means that you don't have any control of those underlying 500 names. You're just kind of tracking their performance. By direct indexing, you go and you buy the 500 names directly yourself in your broker. And by doing that, it allows you to automatically tax loss harvest. Why that's important is when names come down a little bit, other names move around, volatility, whatever, you could take advantage automatically on public.com what these moves do to a portfolio to say, hey, we had some volatility in April of this year with the Trump tariff tantrum. You can now maybe take advantage of some of that volatility by realizing losses that then offset capital gains in the future. For example, Robert and I have been direct indexing in the past for the last I think it's been about 15 or 16 months, Robert. And since doing that, we've tax loss harvested just about $2,300 against the initial $20,000 invested, which by the way is now worth about $26,000. So we realized a 30% increase in the portfolio as the S&P went up. We tax loss harvested about $2,300 along the way, and it's all automatic, all cool stuff. And so Public is now offering that same service. So what would I do in your situation? Mandy, I would probably stop buying net new shares of ETFs and just take that new capital and direct index it instead. I'm not saying to go sell your shares of VOO or QQQ because that would be a taxable event. I don't think that's smart. Just keep rocking and rolling. Long-term capital gains are your friends here. But net new capital, I think, should be deployed head toward a direct indexing type of protocol or strategy, allowing you to take advantage of those tax loss harvesting efforts.
Yeah, I think your breakdown is perfect. Any net new capital, I would put in the direct indexing, but any capital that you currently have in VOO or QQQ, I would leave put. Now, if I was starting from zero and I had $100,000, I probably would break it down and maybe do 50–60% VOO and then the rest in the direct indexing, because keep in mind, direct indexing does have higher fees. It does have some little things that are different, but overall, I think it's a great strategy to have both, but all net new capital in this instance, I would definitely agree with Austin, put it into the direct indexing.
Now, our next question comes from Emma G. Emma says, "Hey, Robert and Austin, I hope you can settle a debate. My friend and I follow your strategies. We have our brokerage accounts, fully funded emergency funds of $15,000. We have maxed out Roth IRAs. We've matched our 401ks, and we have our bridge accounts. But here's where we have a conflict. We don't know how much to keep in our checking account at the end of each month. For example, at the end of the month, I like to bring my balance down to about $3,000 and then invest any amount of money above that figure. But my friend keeps $10,000 in her checking account and invests anything above that. My argument was that even though my $3,000 might seem a little high, since we have credit cards that can cover immediate purchases until I pull funds out of my emergency fund, she thought that $3,000 might be too low. So I think it's too high. She says it's too low. What are your thoughts? Thanks in advance. P.S. My newest toxic trait is multiplying all my expenses and my friend's expenses by 70x, because you guys say that every dollar invested in your 20s turns into 70 in retirement. Best episode you've published, hands down." Well, thank you so much, Emma. We really appreciate that. That's so funny, Robert. That is a toxic trait.
I love it, but I'll take this one first. Here's my take on this. And people get this wrong. Most people get this wrong. They feel they have to have all this money in a checking account to make it available, like all their other money in a high yield savings or their brokerage account or whatever it is unavailable. And it always bothers me, because I always say you want to make your money work as hard for you as you work to get it. So in this instance, I think you're both somewhere in the middle. I would say instead of 3,000, I would up it to 5, and instead of 10, I would come down to 5, because I think that's a great sweet spot where you have some cash on hand so you feel comfortable. But always remember, for those of you that are sitting on 50,000, 100,000, 200,000 in your checking account, you're leaving money on the table. You don't need that much money. I can go to my brokerage account right now and in 2 to 3 hours get 100,000, 500,000, whatever I need for something that would come up. So don't let that much money sit. I agree 10,000 is too much. I would park it all at 5,000, and then that way you'll be safe and everything will be great.
Yeah, so I just logged into my bank account. It's November 3rd when we're filming this right now. So the month of October has wrapped up. I've paid off all my credit cards. I've done everything like I do on a monthly basis here, right? And I've got $4,400 in my checking account. So that's my real number, my real kind of like what I do on a month-to-month basis. Is 3,000 low? Not really. I mean, if you want to have 3, that's fine. Is 5,000 too high? No. Is 10,000 too high? I'd argue yes, right? I think once I get above like the 5, 6, 7,000, then I'm like, okay, wait a second. I need to like put this money somewhere so it's growing for me. It's not just sitting in my checking account. So yeah, I'm kind of right in the middle there. $4,400 is what I've got in my checking account. We just wrapped up October. Just paid my bills, paid everything normal. I haven't paid myself yet for the month of November, but that's what I got in my checking account. I think it aligns right with what Emma says at 3 and what Robert says at 5. So a general framework that I like to think about here is about 1.5 months worth of what I would make on a monthly basis, right? So like, let's say for example, you're someone that you're Ireland and you're making about $4,000–5,000 a month. I think it's totally fine to keep $4,000, $5,000, or $6,000 a month in your checking account any given time. Like that's like just a good place to be. Now, if you are someone who's making a whole lot of money and you're really saving and investing a lot of it, sure, like make sure that you're not putting aside too much. But Robert's general framework here of 5,000 at the end of the month, obviously I follow that. I'm very close to that. 3,000, I've had months where I'm around 3 as well. I'm a little bit more aggressive on those months. But at the end of the day, as long as you aren't having thousands of dollars more that could be saved, that could be invested, right? That's genuinely eating a hole in your pocket thanks to inflation, you're going to be just fine. There's no like perfect rule for it. Just don't be too cash heavy.
Yeah, I remember my ex one time, she wanted to see all of my bank accounts and I show them freely. And she's like, "Why don't you have any money in your checking accounts?" I'm like, "Why would I?" And she's like, oh, well, my parents always keep a minimum of $100,000 in their checking accounts in case of emergency. I go, that's what an emergency fund is for. I want my money to be active, and you have to make sure you're always deploying it. Yesterday, I had a little bit of extra capital that came into an account, and I was like, what am I going to do with this? Above the threshold that I like to be at. And I just moved it around, put it into public.com, moved some other things around, and now I feel good again because my money is working as hard as I work to get it.
Now, our next question comes from McDonough. McDonough says, hi, Austin and Robert. I'm a big fan of the show and really appreciate how you break down real-life financial situations with clarity and perspective. I'm 52 years old, married, and my wife is a stay-at-home mom. We have 2 boys, ages 13 and 10, and here is our financial situation. We have $1.5 million in a 401k, $1.7 million in our bridge account, $1.3 million in employer stock, with about $850,000 of that vested, $275,000 in the 529 accounts for our 2 kids. Our house and our cars are fully paid off, and we spend about $10,000 a month on our living. With all the advances in AI and the current economic situation, I'm increasingly worried about a potential layoff. My plan is to work another 3 years or so, but if that becomes difficult, could I retire today and still maintain a comfortable lifestyle? Thanks again for everything you share. I really enjoy the show and would love your perspective on my situation. So Robert, I'll kick this one off. If you wanted to retire today and live a comfortable lifestyle, you probably could, but it'd be a little close, right? So let's say you have to take in roughly $150,000 of portfolio income that's then taxed as a long-term capital gain at 20%, just to be conservative, keeping you at that $120,000 per year in spending on your, monthly expenses here on that credit card that you had sort of laid out for us. So you have to make $150,000 a year in portfolio income before taxes to sustain your lifestyle. The 4% rule tells us you would need about $3.8 million invested into stocks and bonds, allowing you to take off that 4% and never run out of money, right? Quote unquote, never there. So theoretically, you've got the $850,000 of employer stock, you've got $1.7 million in your brokerage accounts. Like that gets you to about $2.5 million, which is great, but it's not that $3.8 million. So could you retire today? You absolutely could retire today, but your spending would have to come down every month to about $6,800, because that would then keep you into an after-tax 4% rule kind of range. Now, you don't have a mortgage, you don't have a car payment, you're not contributing to the 529s anymore. Like, what does one spend $10,000 a month on today? Like, I couldn't tell you, right? Having no debt, like, what are you spending 10 grand on? Like, that's a lot of money. So like, oh my gosh, we have to like tighten our belts a little bit and raise our 13 and our 10-year-old on just, $6,800 a month, assuming no mortgage payment, no car payment, no debt at any, like everything says fully paid off. So I think you could do it if you needed to, but here's my advice. Work until you're 59 and a half, let the 1.7 grow. It'll probably double in that next 7-year period of time. So now we're talking about 3-ish million. Let the 1.3 million employer stock grow as well. Maybe it's closer to 2 million over the next 7 years. Let the 401ks grow. That'll do, let's call it now that's from 1.5 to 2.5 or 3 million. So let this money grow. Now you have $3, $6, $7, $8 million in 7 years from now, when you can actually touch the money at 59 and a half, you are super rich at that point. $6, $8 million. Oh my gosh, you are having a really good time. Everything's paid off. You go travel the world. You buy whatever you want to buy. You made it. Congratulations. But I would work for the next 3, 5, 7 years if you could, at least until you can tap into that 401k. But Robert, what's your take on this situation?
Yeah, I think you killed it. They're doing great. They do need a little bit more money, so they need to keep multiplying and working a few more years. But here's what I would do. This is the only thing I would add. Everyone watching this episode needs to be concerned with, what is AI going to do to their job? Is it going to displace their job? Is it going to change their job? And in this instance, you have time. At 52 years old, you could spend the next 18 months in whatever job you're in, because I don't think it shows what you do, and you could really get dialed in AI to be the best at it at your company, in your division, or whatever it is you do. And then there's a world where maybe you even make more money and don't have to worry about this displacement, or worse, getting laid off. That's the only thing I would add. Everyone has to understand AI is here. It's happening. You can't get around it. So embrace it, learn it, and see how you can benefit from it rather than worrying about it, but also prepare like we're talking about in this question. Because if you do lose your job, you have to have more money than you anticipated because, before AI, you probably thought you were on easy street for the next 10, 15 years at your position. That goes away with a lot of positions and a lot of sectors in business with the advancements in AI. So prepare, educate, and get ahead of it.
I could not agree more. And I think the big thing that you need to consider here is having that honest budget as well that breaks down between the necessities, like the needs and the wants. Right? I need to pay my mortgage every month. I need to put gas in my car. I need to buy groceries. I need, like, I don't know what the ratio is for you on this $10,000. Like, I live off of $7,000 a month and I pay a mortgage. I pay like a lot, like, you know what I'm saying? Like, there's a lot of fixed expenses in that 7,000. So again, you've got two kids. I don't, like, there's a lot of things to talk through there. But I think at the end of the day, it's really important to say, if I do lose my job, how much of this 10,000 can I trim down so that if I do need to live off of my investments for a while or retire early, I can do that adequately at that, $5,000, $6,000, $7,000 a month range versus this 10,000, and now you're sort of being reactive and not proactive. So our next question comes from Zufan H. Zufan says, "Hi, Austin and Robert. My husband and I recently discovered the Rich Habits podcast and our minds are blown. We really wish we'd found you sooner. Starting in March of this year, we purchased 3 indexed universal life policies with a combined death benefit of $7 million. Together, we're paying $3,800 per month in premiums. 8 months in, we've contributed about $29,000 in total, but after fees and deductions, only $21,000 of that has actually gone into the investment accounts. Each policy also has a cap on returns of 10.25%. Now, after listening to your Q&A episode where you discussed your views on IULs, we're realizing this may not have been a great investment decision. Our big question is, do we surrender the policies right now and accept the loss on what we've already paid, or do we wait until the 12 months are up after the initial purchase where we can reduce the premiums to the minimum, which is $1,200 per month, and keep the policies alive? For context, we're both 29. My husband earns $220,000 a year. I earn $65,000. We bought an investment property earlier this year with a $200,000 down payment. We have a $275,000 mortgage at about 7%. Currently renting for $3,000 a month. We've been paying down the mortgage aggressively, about $10,000 toward principal each month, and the balance is now about $200,000. If we free up money by canceling or cutting back the IULs, would you recommend putting that toward a backdoor Roth IRA, paying off the mortgage faster, investing in a taxable brokerage account on public instead? Thank you so much for your insight. We really value your perspective. So I love this. I love that you guys are thinking critically about where your money's going. Robert, let's talk through it and let's explain to them with numbers, right? Facts, not just opinions here, facts on what could happen in their situation. So they're 29 years old. And let's say that instead of taking this $3,800 a month in premiums to have a combined death benefit of $7 million, they just took the $3,800 a month and they just invested it into the S&P 500. And let's say the S&P grows at about 9.5% per year from 29 to 67. You're talking about $17 million. That is your money that you get to now pass down to your children or anyone else you want to give the money to when you die, right? There's no this is your 17 million. Congratulations, right? That's what $3,800 a month from 29 to 67 turns into. Let's say it's 29 to 65. It's still $14 million. So whatever you want to figure that out, you've got over 10, 12, 14, 15, 16, $17 million of your money. Now, compare that to the 7 million you'd have in this investment account with the death benefit or whatever. Okay, so we're talking about twice as better by just keeping it in your own hands. You even talked about how you've already paid $8,000 just in 8 months on fees alone, which I think is absolutely ludicrous. So you're essentially saying now, hey guys, do we keep the policy, keep paying the $1,200 a month, and then use the other, let's call it $2,600 a month and figure out what to do with that? Do we keep the policies in general? Our answer, Robert, has always been no to IULs and yes to term life insurance. And here's why. What is the goal of insurance? What is the goal of life insurance in general? The goal of life insurance is to provide income in case someone dies. right? So now you've got someone in your family that you depend on. You said your husband earns $220,000 a year. If your husband passes away, you now don't have $220,000 a year. So what do? If you had a life insurance policy of $3 million or $2 million, you could take that 2 or 3 million, let's call it 2.5 million on average here, put it in the stock market, take out 5% per year, and you now have $125,000 of annual income to add to your $65,000. That is how you now survive until you can figure out your now new situation without a husband. Life insurance is to supplement the income of the person who died, right? What if you can now self-insure, right? What if you already have so many millions of dollars invested that you don't need to have this lump sum? The two of you now already have so much money that if one of you dies, the other person can live off of the existing, sort of nest egg that you've created. And that to me is what term life insurance does a great job of executing upon. So term life insurance says, hey, for the next 20 years, I'm going to pay, I think right now, Robert, I pay like $110 a month for my term life insurance. I have a $2 million policy myself. So it's like I pay $110 a month. If I die, $2 million goes to the beneficiaries and rocking and rolling there. Then that can get the 5%. We're talking about hundreds of thousands of dollars at that point. In your situation, you could do the exact same thing. For $110, $150, $200, whatever it is, it's a lot cheaper than $3,800, right? So now you've got this ability to have this massive nest egg in case someone dies. And then while you are over the next 20 years during the term, right, you take the difference there. So that 3,800 minus the, let's call it $200 a month, just to be conservative. Now it's $3,600 a month you can park in a brokerage account over a 20-year period of time. Assuming you have absolutely nothing in this brokerage account right now, you now have $2.5 million, which is the exact amount of money you just insured yourself for. Congratulations. You don't need term life insurance anymore. You now have $2.5 million in a brokerage account. And then, at 49 years old, you are self-insured, and now you can continue to grow your wealth. It's a common misconception to think that people can get rich with insurance policies. They think that insurance policies are investments, and they're not. They're insurance. They're insurance, right? So just like understanding the difference between this is an investment strategy, which are real investments into a public brokerage account or a Roth IRA or whatever else, or this is an insurance policy that ensures that if I die, X amount of things actually happen. When you begin to combine the two, that's when you start paying fees. That's when you start, get front loaded on the wrong things and they put you in the wrong things. It's just a recipe for disaster. So please, Zufon, highly recommend surrendering the policy, taking the hit on what you've paid. Call it a silly tax, call it a stupid tax, call it a I've learned my lesson tax, whatever. We've all paid them. Robert and I certainly have paid them. And get rid of the policy, take that $3,800 a month, take 200 or 150, whatever it is, get a $2 or $3 million policy, term life insurance policy on you and your husband specifically. And then Robert, I now want you to tell our friend here what they should do with the other $3,600 a month. Do you think that they should pay down the mortgage at 7%? Do you think that they should be, pay down the mortgage plus then start investing, maybe half and half? How do you think about that?
No, first, I love how passionate you are about this question. We haven't been asked about IULs in a while. And I just want to talk about this just for a quick second because you crushed that. And that is, an IUL is not an investment. And anyone that sells you that it is, you should unfriend them, never do business with them again, and never trust them again. Because at the end of the day, if I invest in VOO in the S&P 500 and I invest $3,200 a month and then stop, guess what? That money keeps growing forever and ever and ever, and it compounds on itself. With an IUL, when you miss those payments, your policy ends, your money is gone. And on top of it, which was highlighted in the question, you are paying a ton of fees. And don't let them kid you. These are administrative fees, policy fees, but also really high commissions. So that is why I really struggle with people that sell IULs. I think it's really, really bad, and they should not be able to sleep at night because it's not an investment, and it's definitely not fair or sound for the person's financial future. And Austin, you did a great job breaking down the numbers. So to answer your question, Austin, I would do exactly what you said. I would not pay down the mortgage and pay extra on the mortgage just yet. And if I was going to do that, I would maybe only do that with $1,000 a month of the funds, because there is a world where we start to see these rates come down more and more over the next next 2, 3 years. And you could be lowering your principal over time by paying extra, but I would still keep investing in the market because I think there's a bigger win there, like you illustrated with your numbers, Austin. So that's what I would do.
I like that a lot, Robert. I think at 7% interest rate, right? I understand that you want to pay that mortgage down, and I think you should pay it down. It's really at that cusp where it's like, if it's eating at you, if you feel weird about having 7%, I'm not going to get mad at anyone for paying off a debt that's at 7%. So let's just be clear on that. But to the same point that I just made and that Robert did a great job of illustrating, which is like, if you are not putting this $3,800 a month into these premiums, what are you doing with them instead to ensure that you come out ahead on the back end in 20, 30, 40 years? That means you have to invest it, right? So go to public.com, direct index it. That's what you do, Robert. You go to public, you direct index it. Now you're getting a double whammy. You got the money growing for you in the S&P, and you're taking advantage of tax loss harvesting. Sounds good to me. So yeah, if you want to pay off the mortgage, you could do some of that. But at the end of the day, I would focus more on getting that money invested, growing this $3,800 a month into 1 million, 2 million, 3 million, 4 million by the time you're in your, late 40s, early 50s, and then say, okay, cool. Like, one, I don't need to have life insurance anymore. I'm self-insured. And two, oh my goodness, could you imagine if we had this money still sitting in these IULs, we wouldn't have access to any of this money. Because that's the thing. It's like, it makes me so mad, Robert. If people want access to their investment account, they have to borrow it. Why do you have to borrow money that's yours anyway? It literally makes my blood boil thinking about how people make so much money getting rich off of people's ignorance toward these indexed universal life insurance policies. I get so mad. We got to move on before I get even more. I'm gonna get green and turn into the Hulk.
Yeah, I could keep going. We could do a whole 2-hour episode on this. I looked at a contract a few months ago for a couple that was in a similar situation, and it was so complex, my team at Croak Capital could not figure out this company's cost structure and what the fees were, and that's intentional. Whereas we can go buy VOO on public.com and know exactly where our money's at, have access to our money. And think about it this way, Austin. Right now, the S&P 500 is set to return over 20% a year for 3 years in a row. And so think about that from a perspective when people are worried about paying off a mortgage at 7%. Like you said, it's right on that cusp. But I do think there's a world where I would pay some of it down, put the rest into the S&P 500, do the direct indexing, and never look back. But before we get into our next question, and I know that was very long-winded, Austin, and I love it, listen up, folks. You can lock in a 6% or higher yield with a bond account on Public right now. But remember, your yield isn't locked in until the time of purchase, so you might want to act fast. Lock in a 6% or higher yield with a diversified portfolio of high yield and investment-grade corporate bonds, only at public.com/rich habits.
So our next question comes from Nico S. Nico says, hi, Austin and Robert. My financial advisor is telling me that my wife and I do not qualify for a mega backdoor Roth solo 401k. I have an LLC, which is an S Corp. And the reason they said is, based on my research and conversations, the mega backdoor Roth solo 401k strategy is very attractive, but may be difficult to achieve its benefits due to non-discrimination testing, particularly only if the highly compensated employees are participating and the non-highly compensated employees are not participating. So then Nico goes on to say, do you have any idea how I can get around this? What do you think about the mega backdoor Roth solo 401k versus just a backdoor Roth IRA? What do I do? So let's talk about this, Robert. The mega backdoor Roth solo 401k is essentially, I don't want to call it a tax loophole because it's not, it's in the tax code, but essentially what you can do is you can really, really, really turbocharge your retirement investing, assuming you are an LLC, an S Corp, and you are the only employee of your company. For example, me. I have an LLC, it's taxed as an S Corp, and I'm my only employee, right? So I pay myself a salary and I pay myself owner's distributions, and I pay taxes, federal, whatever. Like I do all my normal stuff. But what's cool about how I've built this is if I want to, I can contribute up to, I think it's like $69,000 or $70,000 per year toward my mega backdoor Roth solo 401k, which is after tax contributions, just like a Roth IRA. So I'm essentially contributing 10 times more on an annual basis than a normal Roth IRA at $7,000 a year. Now, what are some reasons why you can't do this? Reason one, your tax structure is not set up correctly. Maybe you've got a partnership. You have you got to make sure it's an LLC, S corp. You're rocking and rolling that way. Two, you can't have employees. Now, your spouse does not count. So if you do have a spouse and your spouse works in the company, you guys are owners, whatever, you both can have mega backdoor Roth solo 401ks. But if you have real employees that are on a payroll, like it's no longer a solo 401k. It's like, congrats, now you have a normal 401k and you got to figure this stuff out. Now, the difference is between a normal 401k that's like, you're doing versus the solo. The solo 401k, you can turbocharge that thing up to 70,000 or 69, whatever the number is there per year. Where if you have a normal 401k plan and you have employees, every single person that contributes to the 401k has the exact same match, including you. So you might say, hey, I want to have my company match my contributions way more than my other employees, because heck, listen, it's my company. I'm running the business. I'm running the show. I took on the risk. I did it all. I deserve the higher match. Unfortunately, and this is how I understand it, I'm not a CPA. Don't take this as Bible. But how I understand it is if you do offer a 401k in your business and you have employees who are participating in that 401k, every 401k participant, including yourself and your employees, right, including your highly compensated self versus your non-highly compensated employees, have to participate the exact same way, receive the exact same match. Everything has to be the same. So it makes sense why your financial advisor is telling you that the non-discrimination testing, right, is not going to allow you to pass this. So what are some ways around this? Go create another LLC, make it an S corp, make you and your spouse the only employees of that S corp, pay yourself a reasonable salary, and have the revenue generated to that new LLC come from the previous company, right? So your existing LLC, pay yourself like a consulting fee every month of like 5 or 10,000. I don't know how much you're moving around here, but go put in 70, 80, 90, $100,000 a year into this new LLC, run yourself a normal salary of 60, 70, 80, 90,000 as CEO. And then literally all of the money that you make as a salary, just use that now as a contribution towards your mega backdoor Roth solo 401k for this new company. I've seen that work. I think that might work. I'm not a CPA. Please do not take this as tax advice or accounting advice or whatever. Go talk to someone that can actually walk you through this. How I understand it is you can go consult this existing LLC where you've got all these employees. You're paying yourself a $5,000 a month consulting fee. Now you run that $60,000 a year as salary to yourself as an employee. After taxes, you're taking home, let's call it $40,000. All $40,000 of that can be added to your solo 401k, right? So like, you got to make sure you work with someone right on this, but I think that this would work in your situation.
Yeah, I love that breakdown. And Nico and anyone listening, get a second opinion. Always get a second opinion. I always look at it this way. If you're a high earner and you're building wealth and you're relying on Bill down at the corner at Morgan Stanley or someone at Edward Jones to give you all of your tax advice, all your retirement advice, all your investing advice, you're making a mistake and likely leaving money on the table. And it's just like, you have to understand, get a second opinion. If you go in for heart surgery, you're not going to take the first person's opinion. You're going to get multiple opinions because you want to make sure you do it right. Same thing should go with your money. That is why Austin and I do what we do every single day, is to spread the good word of financial education and to help people, because personal finance is personal. Austin, I think you did a really great breakdown. I think you are absolutely correct in what you stated. And I would just get a second opinion, Nico. Go find a CPA, go find another financial advisor. I can link you up with a free call if you wanted to message us on Instagram with Croak Capital, but there's always a way to work around these things and build wealth the right way through these structures.
I couldn't agree more, Robert. And I think what's really important too is that you understand it's okay to pay a pretty penny for some good advice, knowing that that good advice can save you or make you so much money on the back end, right? So if you have to work with someone and pay them an hourly rate, that turns into several hundred, if not a couple $1,000s to help you work through how this is all going to come to be. But now because of that, let's call it $2,000 bill you just had to pay, you can now extra invest 40, 50, 60, $80,000 a year into different accounts. You're doing these different things. It turns out, like, what's the phrase, Robert? People walk over dollar bills to go pick up nickels, or walk over, quarters to pick up pennies. Like, don't be that person. Like, it's okay to spend money for good advice. And we think that working with a good accountant is very, very powerful.
Yeah, don't pick up pennies while dollars fly by. And I love that. And it goes to what Austin and I say all the time. It's not what you make, it's what you keep. And by having really strong structures and tax strategies, you will earn so much more and gain so much more in your lifetime and create so much more wealth by structuring things correctly.
So our next question comes from Fred S. Fred says, "Hey, Austin and Robert, you can call me FJ. All right. What's up, FJ? FJ says, I've been listening since April 2023 and will never stop. Let's go, FJ. That's so hype. FJ says, a little about me. I'm a sophomore finance major at a private university in Fairfield, Connecticut. I have a question about what to do with $10,000 in cash that I've set aside for rent my senior year. So FJ says, I've already signed a lease for an off-campus house that's going to cost me $18,000 for 9 months. I'll have 7 other roommates. Yes, it's $144,000 for the school year. It's ridiculous. But it's one of the cheaper townhomes and cheaper than living on campus. Right now, I'm 20. I have $7,900 in a Roth IRA that's maxed out for 2025, $10,200 in a brokerage account, $300 in crypto, $7,000 in savings that I'll use during the school year. I usually make about $15,000 each summer, but I earned $33,000 this summer from an internship. Part of that $33,000 was a $16,000 bonus, $4,000 of which I still hold as equity in the company. My main question is, what's the best way to grow the $10,000 over the next 2 years to help pay my rent? Or would it make more sense to use this money to max out my 2026 Roth IRA contributions, save as much as I can for rent, and take out loans to cover the remaining amount? Thank you, and looking forward to hearing your thoughts. So you've got $10,000 set aside for rent your senior year, and you've got $10,200 in your individual brokerage account, and then $7,000 in savings that you will use for the. So here's what I would do. If you need to set this $10,000 aside to help pay rent, set it aside in a high yield savings account, and then use the money that's in your individual brokerage account to contribute to your Roth IRA. Right? I'd much rather see you have a maxed out Roth IRA of $7,000 a year in 2026 than $7,000 in a taxable brokerage account, right? And you have $10,000 in this taxable brokerage account. So use that money to max out the Roth IRA. Oh no, it's taxable. I got to sell my holding and I'll pay it. Cool, whatever. Pay your taxes. Congrats, you made some profits. Move that money into a Roth IRA, let that money now get invested correctly, because that's going to really grow and be tax-free when you're in retirement. And so don't even worry about like using this, $10,000 for rent money to go invest the Roth IRA. You've already got the Roth IRA now figured out. Now it's like, cool, what do I do with this $10,000? Put it in a high yield savings, get your 3.5%, maybe 4%, depending on if you can get a little promotional deal there. Congrats, you're now making $300 or $400 extra a year on it. And then once you have to pay rent, you pay some rent, and hopefully you don't have to take out that much in loans. What do you think, Robert?
Yeah, I like that take, Austin. The only thing I would change is I would probably take the 10,000. I would put 6 or 7,000 of that into the high yield savings account. And then I would take 3,000 of that and I would split it between Bitcoin, Ethereum, and Chainlink to get some risk on assets in crypto, because with his age and situation, I think it would be worth the risk to risk $3,000 of that to get some really outsized gains over the next couple of years and catapult him into a better situation for this rent coming up senior year.
That's what's fun about the show. We're allowed to disagree. I disagree. I wouldn't take on the risk. I think rent money is more important than crypto money. But Fred, or FJ rather, you got our takes. So our final question comes from Christine S. Christine says, hi, Austin and Robert. First of all, thank you. I started listening to you 2 years ago, and you've changed our lives. Thanks to your advice, we have managed to save hundreds of thousands of dollars between our 401k, IRA, 539, and we also have set up a brokerage account that has just taken off due to all of your advice. I'll be grateful to you for my entire life. Jeez Louise, this is insane. Thank you so much, Christine S. What kind words. I'm so excited. We didn't do anything. You did it all. We just gave you some information. You're the one that took notes and took action. So congratulations. Christine says, now here's my question, and I don't think you've addressed it yet on your podcast. Our son is a senior in high school. He'll be attending college in the fall of 2026. We'll have about $60,000 in his 529 by then, but that won't pay for all 4 years. It'll only pay for about 2 years. We're high earners, so we will not qualify for any aid. We can afford to pay the rest of his college with money that we earn from our jobs. We're not going to take out any loans. Don't worry, I've heard y'all talk about this one. Debt-free education. Finally, we're in a great position with little debt, and we are set to retire early, maybe even at the age of 59 if all goes well. So here is my question. Do I withdraw all $60,000 out of the investments, keep it in CDs and other money markets to grow inside of this account for over the first 2 years here so we can pay as we go the first 2 years? Or should I withdraw the money in 4-year increments and then pay for the rest of the education through our salaries and things of that nature? All right, Robert, so let's talk through this. So Christine's essentially saying, hey, I've got $60,000. It's going to cost $120,000 for our son to go to college, and we can cash flow the remaining $60,000 ourselves with our salaries. And so we're trying to figure out, hey, do we completely cash out the 529 account and use it to pay for the first 2 years? Or do we only cash out a portion of it and then, use our salaries to do the rest? What's your take on this one, Robert? This is an interesting situation.
It is a really great question. Here's my take. If you have enough for the first 2 years, I would do that. I would pay for everything the first 2 years and take the equivalent amount that you're going to be investing for the last 2 years, and I would start getting that moving now rather than splitting it up over the 4 years, because then you have compounding, you have interest, you could put it in CDs, maybe treasury bills, high yield savings, depending on which one's paying better. That way you're gaining value over time and building more money, so it's not as much out of pocket for you, rather than splitting it up in 4 years, where then every year you're coming out of pocket. That's what I would do, because I believe the math is going to really work out in your favor, even if you're only making 3, 4, 5% on the money, because that way for the first 2 years, you've got it covered. And for the last 2 years, you have that 24 months to grow this money.
Yeah, so how I'm thinking about this is like, okay, great. You have $60,000 in this 529 account. One, make sure that it's not invested anymore. All right, it's been invested for years now. It's grown into $60,000. Cash in on those investments and make sure all $60,000 is in some sort of like short-term T-bill account that's paying 3 to 4% per year. So that's how you get an extra, let's call it, $2,000 per year in just yield by having your money sit in the right cash accounts inside of your 529. So one, cash out of the investments, make sure it's like, cool, we now have the 60K, rock and roll, and it's earning a little bit of interest for us along the way. In my opinion, I would keep it like that. And then like, cool, year one for college, 30 grand. So we're going to take 30,000 out of that. So we're going to sell whatever those like little, cash ETFs that we're sitting in. We're going to sell the ETF so we get 30,000 of cash. We're going to deposit into our checking account and we're going to pay for first year. Awesome. Now it's the second year, 30,000. Again, we're going to cash out, I guess, the rest of this account, use that to pay for the second year. Now we have 2 more years of school where we do not have another $60,000 to pay for it. So yes, cash flow it. If you got an extra $30,000 that you and your spouse can take from your salaries to pay for that, rock and roll. Same thing with the final year there in year 4. The only thing that I would add to this is, depending on the state you live in, sometimes you're able to get some like tax benefits from contributing to the 529. So instead of, and it's not like this in Tennessee, unfortunately, so I don't have like a good example to give you, but like I know some states, you get to write off a percentage of those contributions or up to a specific amount of those contributions against your earned income, your taxable income. So instead of paying for college tuition straight from your personal checking account, deposit that amount into the 529 and then pay for it out of that account, so that when you go to your accountant and you're able to like, do your taxes and your filings and stuff, you can say, Yes, over the last 2 years of my son's college, we contributed $30,000 in year 3, $30,000 in year 4. We can write off however many thousands against our taxable income, saving us an extra couple $1,000s along the way. That's how I would try and optimize for it, but you're not going to earn money on this. It's just using it as like a pass-through account so that you can take advantage of those tax situations. But no, you did a great job. Congratulations on getting so much money invested and being so diligent. The only thing, and again, call me crazy, I know you already addressed it here. $100,000, $120,000 even, right? $120,000 for a college education is bonkers to me. Absolute bonkers. I don't know what college your son's going to. I hope he becomes a doctor for all, I don't know, right? But 120 grand is a whole lot of money to pay for a bachelor's degree that's going to earn your son, let's call it $75,000 a year out of college. I would like to see that much closer to 35, 45, 50,000. Maybe it's an out-of-state school. I don't know, but who cares? You paid for it. You know, he's not taking on any debt. All is well. You guys are doing great here. But geez Louise, that's a lot of money.
Yeah, I didn't want to go down that road of is it the right idea or not, because we could go 15 different directions on what to do with this money. But what a great episode. So many incredible questions. Thank you all so much for following along and always engaging with us. We love, love, love getting all these complex questions so we can break it down and really just try to bring as much value to each and every one of you that we can. So we appreciate you following along. Always make sure to share the podcast with someone that maybe needs a little nudge in the right direction financially. We're here for it. Get them involved. Join the newsletter. We still have the 7-day free trial going right now for the Rich Habits Network, which is awesome. We spend 2.5 hours every single week going through what we invest in, what we're thinking about, what are the markets doing. So if you haven't checked it out yet, the Rich Habits free trial link is in the show notes below. And thank you all for joining us.
Thanks everyone again for hanging out with us on this Thursday Q&A episode. Please go check out public.com. Please go check out the Rich Habits Network. And if we provide value to you in these shows, please consider leaving us a 5-star review on Spotify, Apple Podcasts, subscribe to the YouTube channel, leave this video a thumbs up, all the fun stuff just to show support. The show's completely free. It's funded by advertisers, which is incredible. So nothing that you guys need to pay for or do. Just please continue to show support. We really, really appreciate it. Thanks everyone. And really sorry to admit, we will not have a Rich Habits Radar episode come out tomorrow. Robert and I are spending the week in New York City with Google, which is really exciting. So we'll give you guys some updates on that for the podcast next week. So we won't have time to film this week's episode of the Rich Habits Radar. Regardless, stay tuned. We'll see you Monday. Back to regular programming. And thanks. Have a great weekend.